This is the Daily Market Rundown live from the Tradelo trading floor. It's March the 19th. Some highlights from today's show. Shots fired again. Stagflation fears are rising in the US. And GBPUSD is now in play. Good day traders and welcome to another daily market rundown. Having a look across the screens, again a quiet European session. As expected, of course, we do have the Fed in play later on today. Now with that in mind, if you missed yesterday's rundown of the Fed, that includes some of the key things to focus on and some of the key tradable opportunities, do have a look in the description of this video. You will find the link to that video, which is available for free on our YouTube channel. Now with that in mind, let's turn our attention to the first topic and have a look at some of the overnight news, starting of course with shots fired between Russia and Ukraine. So this sort of idea of a ceasefire, I think the best way to summarize it was actually how one of the traders put it, which was, it was not nothing, but it was not something. And I think that's the best way to ultimately look at yesterday's sort of agreement that was had between Trump and Putin. It was not nothing, it was not something. Okay, they agreed to not shoot at each other's energy infrastructure, but ultimately that's kind of all they agreed to. Now I think this is very much perhaps to show a little bit of face. We do know that of course Trump was adamant in his election campaigning that he will solve this conflict on day one, and he'll get it done straight away because he's a deal maker. So I suspect from the US side, they really did want to save face to make sure that there is some progress to be had, of course, given the promises that have been made. But I think they ran into the reality of the situation, which is on the Russian side, they do believe they have all the cards. They do believe that right now, in terms of territorial gains and in terms of the way the war has gone, that they have the rights to demand as much as they want. And I think that's ultimately the framing of what's going on there. Now, I appreciate, don't assume I'm any expert on this, I'm not. But looking at this purely from a probabilistic perspective, the realities on the ground is we're not going to get a deal anytime soon, because I think there's a lot of things that need to happen before that becomes an eventuality. Now, what that means for us as traders is I suspect there's got to be a little bit of escalation involved with this. I don't think things get solved quickly. I think it's kind of a situation now where we have to have some form of escalation and then ultimately we get some form of de-escalation and eventually some sort of a deal. What does that mean? Well, I suspect we are going to see some headline news coming over the wires, perhaps today, tomorrow, or into the weekend, where the US looks to enforce some harsher sanctions on Russia. Now, this can come in the form of a number of things. We obviously Trump did tell us they could come in the form of financial, they could come in the form of obviously embargoing and really making restrictions on a lot of the oil flow out of Russia. It could come in the form of some of Russian assets that are currently frozen. So there's a number of ways they can impose this. I suspect from a tradable opportunity, there's only really two things we can focus on. One market is of course the Russian ruble. We know that the Russian ruble has been front running the end of this conflict for all of this year. So we can see the Russian rubles really appreciated over the course of the last 3 months. So I think if you do have access to this market, obviously this is not something we can trade in the future space, but if you do have access to this, I do think we're going to get a couple of days now of some weakness in the Russian ruble, front running ultimately those sanctions coming in. The other one, of course, is the oil market. I think that is somewhere where you can now pay attention. I do suspect we are going to get some positive oil news coming over the course of the next couple of days. So keep an eye on that chart. I think there's going to be some good tradable opportunities there as a result of the escalation that will now take place. With that in mind, of course, there's a nice tweet out from Mohammed Al-Arian, and I appreciate his comments. So this is by no means me saying anything against what he's saying. And I think what he's leaning on here is this idea that the Fed today is going to have a very difficult communication approach, because on the one hand, of course, we do know inflation expectations are rising quite aggressively, but on the other hand, ultimately they do have a slowing economy to contend with. And I think what Mohammed's leaning on is the fact that the Fed is always going to take insurance and lean towards safeguarding the economy over inflation. I think that's what he's hinting at. Yeah, he's leaning on this idea that, well, yes, inflation expectations are rising, but at the same time, the Fed would rather have or safeguard the economy against a recession because they believe they've got the tools to squash that final bit of inflation. Now, I think the one key thing to take away from here is ultimately this idea what Mohammed's talking about, which is this idea of fueling worries about is a whiff of stagflation. And I think that's the second topic to discuss today, because we did get a question about this in one of the FOMC meetings last year, where someone asked Jerome Powell, look, Chairman Powell, do you think stagflation? And I think Jerome Powell came out and said, look, I don't see the stag and I don't see the inflation. Again, he's possibly going to get asked about this today, but I just wanted to go and have a look and just show you a little bit about what stagflation looks like, because is there a whiff of stagflation in there? I think the answer to it's yes, and I'll show that to you on a chart in a minute. But again, we get varying degrees of stagflation. We could very easily argue that the United Kingdom is in a stagflation environment where they ultimately have very high inflation and pretty much negative or very low growth. However, there's degrees of stagflation, and unfortunately, we don't have many playbooks to lean on here. If you're going to talk about stagflation, of course, there was the 70s, and I think that's the real sort of playbook people try and lean on to get an idea of what to trade and how it will trade. But what is stagflation at the heart of it? Well, it's a scenario where you have a low growth environment, unemployment that is relatively high, and of course inflation that is well above target. Now, it's that well above target that's problematic, because is 3% well above target? Well, in the 1970s, I mean, we were talking about double-digit inflation. Okay, are we going to get a return of that? No ways. Okay, we're not going to get 10-15% inflation, and I suspect if we do, we have far bigger problems. Okay, but the point is that stagflation comes in varying degrees of forms, and I think the definition of stagflation implies ultimately that the reaction function of the central bank is very difficult. Okay, I think that's how you have to look at stagflation. It's a scenario in which we have very low growth, but we also have high inflation, which means that a central bank technically cannot do much, because if they cut to support the economy, they prompt more inflation. If they ultimately hike to go and try and bring back that inflation, they'll put the economy in a recession. Okay? And so I think that's how you have to look at stagflation. It's an environment in which a central bank's hands are tied. They can't do much to solve the problem. Okay. Now, with that in mind, just looking at the 70s, you can see that ultimately we had yields rising in the back end. Okay, so we rallied from around 6.8% all the way to 10% over the course of 3 years. Okay, quite a significant rise in the back-end yields. Now, this was not driven by an interest rate hiking cycle. Okay, this was driven simply by very, very high inflation. Okay, now there was a number of things that led to this. This actually started in 74. That's when we had the first bout of inflation. The central bank began hiking, but then unfortunately, they actually started the cutting process too soon. They didn't fully squash the inflation. As a result, they had second round inflationary impact. Okay, 78s to 80s was obviously known as this era of stagflation. The key thing to take away from it is, in a stagflationary environment, the currency typically does very poorly. Bonds do very poorly. Equities do very poorly. Everything does very poorly. Okay, very few things perform well in a stagflation environment, other than ding, 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 this thing in purple, which is the gold market. Okay, and we can see throughout the 70s, 78s, 79s, we can see gold very much rallied from a base of, call it $120 all the way around to 240. So it was a doubling, 100% during that area. And then when the real inflation came in, when those double-digit levels of inflation came in, then ultimately we saw that spiraling of gold, where we went from 240 all the way up to 850. Okay, over the period of 3.5 years, gold rallied 700%. Now again, am I leaning on this idea gold's going up 700%? Absolutely not. Okay, I think the first part of this equation is now true. We can see that gold is trading very similar to 77, 78, and ultimately what it's telling us is it's telling us we have a little bit of a repeat situation where the central bank is comfortable with higher inflation. They're not willing to ultimately restrict policy to squash that inflation, and so people are taking out gold as a hedge against perhaps inflation reaccelerating. Okay, now that's not the base case. That's not why people are buying gold. They're buying it as a hedge. Okay, now fast forward to the present day. Here is the chart. You can see that since the start of last year, we talk a lot about this, since the Fed told us they're not prioritizing inflation, what has gold done? Well, it's rallied from $2,000 to $3,000. Okay, call it a 50% rally in a space of 12, 13 months. What have yields done over that period? Okay, well, we can see since the start of last year, they initially rallied and have since flattened off. Okay, so right now the long bonds are not showcasing a fear around inflation, but equally they're not showcasing a scenario where, don't forget, the Fed is cutting and yields are not coming down. Okay, so what would stagflation look like? I think this is what you all want to know. Well, what stagflation is going to look like is a scenario where even though the Fed maintains a dovish policy stance, yields start to break out. Okay, should we see 10-year yield break above 480 at some point this year? You're going to see a growing a number of economists talking about a stagflation environment where yields are rising in the back end. Why? Because investors demanding higher yield to justify the higher inflation that's coming down the pipeline. Okay. At the same time, you will of course see gold rally to hedge ultimately against that scenario. Now, what squashes this? What stops this from happening? Well, it's very simple. If the Fed comes out and reprioritizes inflation, what you'll see initially is yields will spike. You'll see the front end in particular spike up. Ultimately, that will eventually squash this inflation on the back end side of things, and eventually gold will come back down as those hedges come out of the market. Okay, so is there a whiff of stagflation? Yes, I think definitely. The fact that long bond yields are not coming down despite having a growth slowdown, that is, I think, what Mohammed's talking about. Okay, if economists are revising their growth forecast for 2025, these yields should be coming down. What are they doing? Well, they're not coming down. They're going sideways. And if they start to accelerate now back up to the upside, guess what? That smell of stagflation is going to grow a lot stronger. Now, what's driving a lot of this, of course, is the inflation expectations. We spoke about this in the Fed rundown yesterday, so make sure you watch that session. But the key thing here now, and this is something that participants are watching, we of course know what's happening in the Michigan surveys, but there's now talk that everyone is sort of focused and lasered in on the New York Fed's report. Why? Well, it's done slightly differently. It's a little bit less volatile, and of course, we haven't yet seen the same uptick in the New York Fed's report of survey expectations of inflation. Now, this comes out again, I think, on the 4th of April, so it's a little bit of a while from now, 2 to 3 weeks, but there'll be a lot of market attention on this. Okay, if this does come out hot again, all right, those signs of stagflation or that smell of stagflation is simply going to grow a little bit stronger. Okay, but what we can see from the New York expectations, both at a 3-year and a 1-year, is they are flat around that 3% mark. Okay, if we think about the survey in Michigan, that's sitting around the 3.9% mark, effectively 5 years from now. Okay, so go and have a look at that. Make sure you're aware of this and make sure you are prepared for that 4th of April when we get that data print. Now, with that in mind, gold is of course in focus. It's a market that I've been talking a lot about recently. It's very much in overbought territory, justifiably so. Okay, it's not that the trend is weak at all. I think this trend will remain intact until such a time that the Fed reprioritizes inflation. However, like I said yesterday, we are very much overbought. Now, that doesn't mean we just sell it. It does mean, how, of course, that we have to be very aware should we get some bit of a hawkish pushback over the Fed today. Now, another market to pay attention to, and that is also in focus, is the pound. I think for the first time this year, I think it's sending off some really good sell-side signals. The dollar is very oversold in the near term. That is, of course, on the little bit of a repricing that's taken place with this idea of a little bit of an economic slowdown. However, the rates markets have pulled back over the last week. We can also see, of course, if you have been watching the long bonds in the UK and in Europe in general, relative to the US, they are now starting to outperform a little bit. Okay, so what that means is in the near term, I do suspect that pound is going to have a decent down move back down towards that 128.50. I think that's quite a conservative target. How far back it comes, I think a lot will be dependent on what the bonds do. So let the bonds guide it. Ultimately, though, I think 128.50 should come in relatively short space of time, perhaps over the course of this week, still into next week. Okay. With that in mind, of course, like I said, it's going to be about the Fed. If we get a little bit of a Fed hawkish twist today, of course, we'll trade that 128.50 relatively quickly, perhaps today/tomorrow. And of course, if you do get a bit of a hawkish twist, it does mean, of course, we have a little bit more downside opportunity. And again, in terms of levels, well, there are no real levels. Okay, I think right now we've run into that 130.50 resistance, which has proven itself as really good resistance and support over the course of 2024. We've come into that area very overbought, hence why I think technically and fundamentally now you can sell that pound to the downside. Okay, with that in mind, of course, like I said, it's all about the Fed for today. There's not a great deal out other than the Fed. So do pay attention to what's going on, when we get closer towards that. Otherwise, if there are any other questions, do post them in the Discord channel. Otherwise, good luck out there. Manage that risk. Go make some money.